Please welcome our panellists, founding partner and Chief Executive Officer of ZhenFund, Anna Fang, Chairman and Chief Executive Officer of General Atlantic, William Ford, Managing Partner of GGV Capital, Jenny Lee, Co-founder and Chief Executive Officer of Hedosophia, Ian Osborne, and our moderator, Chairman and Chief Executive Officer of Willett Advisors, Steve Rattner.
Good morning, everybody. So I heard the end of the last panel, and we're going to cover a little bit of that same ground from a different perspective. We have four very distinguished private market investors here, and we're going to cover the world, and we're going to cover China, and we might even get to crypto before it's over. But let me start with the world. It's been obviously a tumultuous year in the markets, public and private, and a lot of resetting going on, a lot of recalibration, and a big slowdown in activity, at least from what we can see at Willett. So I'd like to start maybe with Bill and ask you, you invest all over the world in all kinds of different industries. You're not just a tech investor, you do a lot of stuff. What's your current mindset about the investing landscape? What are you looking at? What do you think is interesting? And what are you saying to yourself, I'm not going to do that again?
Yeah, definitely I'll answer that last question. I think the transition to the digital economy is alive and well. We're still seeing a tremendous amount of innovation and entrepreneurship around the world. And while there has been a reset in the public markets, a significant reset, and now that's translating into the private markets, the entrepreneurship innovation in a range of areas of technology, whether it's Web3, artificial intelligence, things pivoting off 5G, it's all still very, very exciting. And I would also just add in life sciences. I think that's a particularly interesting area. We're seeing innovation continuing, and I think given the reset in public markets and the need for capital, it's a particularly interesting area. But that plus, I would just add, the idea that global economic growth is migrating towards Asia, whether it's India, Southeast Asia, or China. I think that trend is intact and will continue to create opportunities.
So from a geographic point of view, in terms of the areas you find most interesting, is Asia at the top of your list, or is the U.S. still? And how do you feel about Europe, given everything that's going on there?
Southeast Asia and India are at the top of the list right now. I think India is going to have its moment. With the digital India is upon us. 450 million wireless internet users on the Geo platform, leading to a lot of innovation there. I think that'll be a particularly interesting area. I think Southeast Asia, benefiting from basically the idea that people are diversifying supply chains, GDP per capita moving up, a lot of interesting innovations. We're seeing a lot of interesting activity in Vietnam and Indonesia in particular. So I think they would be at the top of the list of areas that we're focusing on right now.
Relative to Europe or the United States?
Yeah, I mean, Europe, despite having, maybe being in recession already, or being, there's still a lot of interesting things going on there in terms of tech and entrepreneurship. I think it's a mistake to rule it out, so to speak. And the U.S. to me is showing a lot of resilience, in lots of aspects of the economy, despite inflation, rising rates. It seems to be, in my view, hanging in there quite well.
And you also invest on a global basis. So how do you see the world? And give us some reactions to what Bill said in terms of where you might agree or hopefully disagree.
I think we agree on Southeast Asia. I think the proposition here is very compelling, and the demographics and the growth rates remain, exceptional. And the commodities boom in Indonesia and things have helped the local market be propped up. To Singapore from Hong Kong and mainland China the last couple of years, and so the ecosystem here is far more developed than before. In Europe, we think it's quite interesting, not because the macroeconomics are compelling, quite the opposite, but because 3/4 of all the growth capital that came into Europe last year was from non-European investors, and as that money pulls back and focuses closer to home in the US or from Asia, the prices have reset perhaps further in Europe than they have in the US or China. And so we do think that Europe's pretty compelling, and it's particularly compelling for us in fintech, given that the the banks and the financial institutions of Europe haven't recovered since the last financial crisis. And so the opportunity to disrupt the traditional players in fintech in Europe is far greater than the US, where the traditional banks, Visa, MasterCard, the insurers are in pretty good health. We don't cover India, so I'll skip over that. But I'd say to Bill's point about biotech, there's a lot of innovation happening clearly. We also see more and more in synthetic biology.
More and more what?
In synthetic biology. And both in China and the US and Europe, a lot of talent is going into that space. Artificial intelligence, too. The challenge of AI is so much of that technology is still very early, and it's hard sometimes to invest in because almost all of those companies get acquired as opposed to IPOs down the line.
Well, we look at some biotech stuff, but honestly, by the third sentence, I'm having trouble following the science. And so how do you invest in biotech? You have a relatively small firm. I don't know that you have a biotech division per se.
We don't do biotech per se. We do synthetic biology, which is sort of for us at the intersection of artificial intelligence, machine learning, traditional computer science, and biology. And so the talent that's gone into that has come out of companies like DeepMind, who built their own independent spun-off business, going after the pharmaceutical industry. I think you'll see more and more companies that with traditional computer science marrying that with biotech capabilities. And so actually China's seen a lot of space in the last 2-3 years, and it's a national priority as well. So you're seeing that not just in the US, but increasingly in Europe and China.
So Jenny, you're based in Southeast Asia, although I know your firm invests globally. You're presumably focused more on this part of the world. So I guess what these guys had to say may be music to your ears, or how do you see your market?
Yeah, so we've been investing. I've been investing in the global market, U.S., China, and Southeast Asia over the last 22 years. I have to say that, as a global firm, we were looking at technology as an enabler for disruption, innovation on a global basis. But today, that lens has changed. I think to your starting point and your message, the world has changed, more complex, more bipolar. And so when we look at technology today, we will bunch them into policy sensitive and policy non-sensitive. So in that sense, if you look at policy...
You're speaking about every country or China?
Global, from a global perspective.
Yeah.
And so if we look at policy non-sensitive areas, these are areas that has been, for example, in the enterprise space, enterprise software, software for the small, medium-sized enterprise, infrastructure software that's enabling companies to migrate their data, their system onto the cloud, right? This is one area where we classify as policy insensitive because it is actually driven by digitization that has been accelerated over the last 2 to 3 years with COVID, right? And so in that sense, we are seeing similar investable trend both in the US, in China, and also in Southeast Asia. There may be workflow amendment that has to be done to accommodate this. But in the world of rising inflation, the impetus to actually use more remote software in that sense actually has gone up. So this is one area where we do see that it's relatively policy insensitive global drivers. The other area that falls into this camp would be automation. Right, today, when we think again about rising labor costs, declining labor dividend, we are now dealing with the fact that we do have to consider labor hybrid, a hybrid model where you're using automation, whether it's software or robotics to work. And that actually is happening, again, not just in the US, as we're seeing many of the factories, as Amazon take a look at their headcount refinement, they're going to have to use more and more automation as well to supplement, the excess capacity need that they need. So this is a demand that's not just something that we are seeing in the US. We are seeing that in China with factories, sometimes, in lockdown mode, sometimes opening up mode. That means they need that flex in capacity enhancement as well. And so the automation wave we are actually observing has actually gone beyond just a ROI consideration into now a hybrid workforce enhancement. And same thing. In Southeast Asia, the driver may be a little different. In Southeast Asia, most of the infrastructure for cities, for countries, they are aging infrastructure. And so when they leapfrog into the next 4.5, 5G, that automation wave comes in as well. So those are trends that we are seeing on the policy non-sensitive area. And now, if you go to the policy-sensitive areas, then we are going to deep tech, right? So, unfortunately, technology now has a label, which it shouldn't be. And in this case, then we are talking about very sensitive technologies. When we talk about semiconductor, for example, then we see that in this way, the investment opportunity is going to tend to be a bit more regional, local. China is going to have and support their own group of companies in China, from semiconductor foundries all the way to tools, similarly to the US as well. And so I would say that that's how we look at the new lens of investment, not just one to change the world, but I guess the world is now broken into little, still huge pieces. But I think tech will have its own regional focus in this case.
Bill, you mentioned India. We just spent, my colleagues and I, 3 days in India. Yeah. And as you know, India has always been something about to happen, and more hope than promise. And all the jokes about India stands for, I won't do it again, I'll never do it again, and stuff like that. So do you think this time India is for real? It sounds like from your comments about where you're spending your time, you think India is for real.
I think yes, for a couple of reasons. And we've been investing there for about 20 years. And our initial success was in the business process outsourcing IT services area, which was entrepreneur-driven and led to companies like Infosys and several others that were quite successful. And I think we're having a rebirth of that entrepreneurship around the digital economy. And really what was missing was a platform like Geo that reduced the data cost and increased access dramatically. I mean, even 5-7 years ago, it was the most expensive data, the cost of data in the world, and the number of people that were connected to fast internet was quite small. Now you've got the complete opposite situations. 450 million people, second lowest data cost in the world. And on top of that, you're seeing a whole series of services, fintech, many other things that are happening. E-commerce is taking off, media is taking off. So I think the conditions are better. It has, it's one of the only IPO markets that's actually open right now. It's the Indian IPO market. So the conditions are there. Let's put it this way, Steve. I think it's theirs to lose if they capitalize on what is in place now.
Yeah, that's fair. That's fair. I want to turn to China in a minute, but before I do that, I'd like to also, just in the spirit of going back over what's happened the last year or so, talk about some lessons learned and what you guys have come away from that experience in terms of how you're going to invest going forward. And let me start with Anna, because she hasn't had a chance to talk yet, but she's going to talk a lot about China in a minute. But before we do that, Anna, as you look, because China's also obviously had its big correction as well, not just the policy stuff, but the markets certainly. And as you look at all that, what lessons do you take away in terms of how you're going to invest going forward, if any?
The number one lesson for me is one word, which is exit. I don't think we did enough of it when the market was good. I think that there's always optimism and greed that come in, and you never want to sell. And for us as angel investors, we can always sell into future rounds before the IPO, and we've done that. I mean, we have 99 exits, but a lot of them rather small. But you got to do that when the market is good. And I think actually in China, there's probably a window in the next 3 to 5 years too, where we can do that. So, because I think as investors, you're really judged by exits and how much capital you're able to return. And so, for me, that's really the most important thing. And that's what I'm hopefully focusing on the next 5 years. As well as founding the founders.
But of course, there are some investors who basically say, you want to compound, and the longer you hold it in a great company, the more you're going to compound, and ultimately that's how the value gets created.
There are all these stories about people who sold Tencent early, and certainly if we had a ByteDance, we wouldn't want to sell that, right? But sometimes you just never know, and I think so far with the exits we've done, we haven't regretted it. And for us, it's maybe just taking a piece off the table before the IPO. But when that window is there, that's just time to focus on that. So that's probably the number one lesson that I think,
Ian?
I think the biggest mistake in the industry, and including for us, is one of governance the last few years. Almost all of the major screw-ups that we've seen very publicly have been a failure of governance. A lack of a proper board which holds the founders to account, often a lack of scrutiny around secondary transactions, related party questions. And so I think in a very hot market the last couple of years, there were certain people, investors out there who are pushing the boundaries in terms of no governance whatsoever, extremely founder-friendly terms, which they position as helping the founders, but frankly, actually, most founders, the average age of our portfolio company CEOs is 30 years old, and so you want to have some checks and balances. And I think in a very hot market, there's pressure to have fewer checks and balances if you want to win the competition. And so, I think for the most part, we managed to avoid some of the high-profile mistakes. But the handful of mistakes that we've made in the last couple of years have been ones where the governance has not been strong enough in those companies, and the founders have had probably a little bit too much rope to hang themselves with.
So exits, governance, but I haven't yet heard valuation. Did you pay too much? Not you specifically, but did all of us who invest pay too much over the last year or two for some of these companies?
Absolutely. I think valuation became disconnected from fundamentals and was trying to attach itself to market size. Hey, we've got a big enough TAM so we can justify this large valuation. But we didn't think about, how fast could the company sustainably grow? What was the long-term profitability? What was the long-term business model? We disconnected from that. And that led to, I think, a significant inflation in valuation, and that we're paying the price for now. And I think the healthiest thing, and actually it's happened even faster than I would have thought, is the reconnection to the point like, okay, what is a sustainable growth rate? What is a sustainable operating margin? Does this have a real business model? And just more discipline around capital. I mean, capital felt free, right? We'll raise the next round. Use as much money as you can or need to drive top line growth. And now I think there's just a new discipline coming back in. It's long term, it's healthy, but there's some pain to be had for having paid too much and raised too much money at too high a price.
Certainly discipline on the side of the investors. It's not obvious to me yet that the recipients of the capital have yet accepted the new reality of what they're going to have.
I think some have. Some are realizing that they've got to have sufficient whatever they have, it's got to get them to break even and get them profitability, putting in some real cost disciplines. Some have not. One place, Steve, that it's starting to happen, though, is around employees. It's employees who are saying, we're not worth $12 billion. You're not going to give me options at $12 billion. We're worth a lot lower than that. And so I think that's actually the first place is the issuance of equity to employees is happening at significantly lower levels than the last round.
Yeah.
And that's causing a little bit of a return to reality. But we're in the early, just the last comment from me, we're in the early innings of the reset in private market values. I mean, it's not done. It may be 2 quarters into a 4 to 6 quarter phenomenon, in my view.
Do you see a reset coming, Jenny, in valuation?
I think the reset has arrived. So for the public company, I think the wake-up call has come in loud and clear, and valuation is staring you in the face. On the private side, I think the first 10, 11 months of this year, what we have seen is that there's been a lot more funding activities on the early stage companies, the pre-A, the A's, early B's relative to the C's, D's. So in that sense, the wake-up call is there for the early stage companies trying to raise their 10, 20 million in the A, pre-A. Valuations has come down anywhere from 30 to 50%. Whereas I think for the group of companies that's raised a lot of capital over the last 2 years, these are the D's, E's, and F. I think they're still waiting for the wake-up call, right? Because they have 2 to 3 years of cash run. They're not in the market right now. They're hearing all these things coming, and they feel like they still have time to allow growth to happen in the next 1 or 2 years. So I would say that for the larger size companies, I think we will be in a very good environment where you can come in maybe at the last round valuation, discount to last round, but at a company that's further growth. In our portfolio, we have seen that the larger companies are still growing at pretty good 40 to 50% medium revenue growth rate. So the growth is happening, but obviously multiple contraction has happened, and therefore they would need to work a lot harder, not just at the top line, but in terms of EBITDA, getting to cash flow as well to justify the valuation that they got in the last 2 years. So I agree with Bill. I think that the hunting is going to get even better in the next 2 to 3 years. But it will require us to be extremely patient and to wait for the companies to be ready.
So let's segue into China. And Anna, let's talk about both valuations but also activity. What's the level of investing activity there? I think it's slowed down as it has in the rest of the world, but there's obviously some very specific reasons in China it might have slowed down. So why don't you give us a picture of what the investing climate in China is today?
Actually, the number of deals we're seeing per week and the number of deals going to IC is relatively unchanged for the past few years, which means there's still a lot of entrepreneurs. The number of investments we're making is probably a third of what we did 2-3 years ago. And that's a result of a higher bar and just what we like to see in the market. In terms of write-ups every week, which I think kind of is a signal to activity level in the VC world, we used to get, I mean, we have a large portfolio, so we probably got 10 write-ups per week. Now we have about 3, and they're all
You're talking about write-ups and valuation.
Write-ups and valuation that other people give our companies.
Right.
So we used to get 10, so that was a lot, and now it's only 3 average. And they happen at the valuations are lower, which means the activity happening is at the early stage, I would say, up to Series B. In fact, official data, I think about 60-70% of the deals are happening sort of through seed A, a little bit for B. 6% is like Series C. So people are investing for smaller companies this year. Very little activity in things at later stage. Last year we had a company, Red, that I guess I can't say, but multi-billion dollar. We share this, a large write-up, but we haven't seen one of those astronomical companies this year, I think, so far.
Because other investors aren't coming in the later stage and creating the valuations for you, is that what you're saying?
I think the main reason is things are so cheap in the public market, and I think that private market hasn't adjusted. If you ask me, I think public market prices are so attractive right now that I'm sure a lot of people in the room even have FOMO about not investing.
Well, some of them have FOMO and some of them have already run for the hills.
Exactly.
There's two
I would
categories
venture to
of China
say
investors.
some have FOMO.
But when you say you're doing fewer investments, so you're being more careful, more cautious, more conservative. Is that why, or why is your actual investing pace slowed down?
If you look at the people who are doing startups now, so I think for me, last year, when there was a demise of a few industries last summer that caught everyone by surprise, we really also asked ourselves can we continue to invest in this environment? And thinking through that question for me was, can I still find exciting entrepreneurs? And we found a host of them. I continue to find them. So there are a lot of Chinese people doing startups. There are a few new pockets of people doing startups. One is the scientific community, because as China has laid out the sectors that, from top down, that they would like to see, like new materials, climate tech, biotech, security, any tech, self-sufficiency. All these characters. There are a lot of professors and scientists who have come out to do startups. I'm not against them, but I think that a lot of the structures of entrepreneurship that they've set up, it's not something that I find very attractive, which is they're not really full-time. A lot of them are famous people who have a technology, but not very entrepreneurial, in my opinion. So I think I've actually stayed away from some of those type of investments, but I think my peers have done a lot of those. So I think that's one reason why we've had fewer this year. Second...
Because there's more of those kind of folks coming?
Yes, because they represent the hard tech, deep tech.
I see, right.
And we've still done some of those, but I think you have to have someone who's willing to do this full time and not do it sort of opportunistically. Because we follow founders, and our whole criteria is about the founders. It's less about what they do. But it happens to be those people, I think, are less entrepreneurial than I would like. The other crop is just the one that we're spending more time with is actually just young people. There are a lot of young founders who are relatively unfazed by what's going on in the macro environment because they've never experienced it. They might be a little more naive. And so they continue to see the world a different way. So those are the founders that I love most. And what are they doing now? They're doing a lot of AIGC related, generating content either for speech, video, text, like live streaming. That I think is the future, kind of like what OpenAI is working for. And that's really something I think we'll see in the next 10 to 30 years in some shape or form. A lot of them are doing drug discovery, leveraging AI for drug discovery and R&D, kind of like a benchling. And then a lot are doing things for like AR, VR. I'm not a big believer in short-term AR, VR, but I think down the line, what's coming after the iPhone, I think there will be some sort of human-product relationship in some form that involves haptics and the rest of the body probably. And I think people are building technologies for that. I mean, the young Chinese people. And then, so that's a group of the young talent. And then I think there's a third group that we call long Chinese, because there are some Chinese people who have built global companies like ByteDance, Xiaomi, DJI. And I think the talent is strong enough, there's no argument there, that they're building companies globally directly. And some of those might not live in China when they do this. They might move to Singapore and the US, and I think these countries should think about how to give them visas, to be honest. But I think that for that talent, we call it long Chinese, and we're also doing that. And Web3 is actually talent going there as well.
But you made an allusion to the policy changes in certain sectors, and we all know, for example, online education was essentially, for-profit education, essentially shut down by the government like overnight. So, and there's been obviously a series of policy pronouncements since then, policy changes even in the last week or so since the Party Congress. So have you changed your investing strategy in terms of sectors based on the government's emphasis on certain policy areas and staying away from some where you think it's become more sensitive, or how do you invest around these complicated policy pronouncements that seem to come out somewhat surprisingly?
I mean, I don't expect any more to come. So I think the most important, I think that if they have listed the ones they want you to invest in, right? But actually, I think it's more around not investing in some of the education or even though they're not, I mean, you have to kind of read between and kind of know what the sensitive information is and just kind of avoid that. But I think for us, we're just kind of following the founders because the founders aren't doing ed tech startups anyway. So we had to change less than I thought, is what I'm saying, because basically all the founders are kind of doing a lot of what was or what is in a general framework of acceptable, whether on purpose or not. But I mean, I think even though, for example, AIGC is not something on the list, but that's just where the world is probably going and what international founders are doing. And I don't think, I mean, there's no harm in doing that, I think. And I think very importantly, I want to point out on this innovation in the government is Vice President Wang Qishan yesterday said the way forward, and I was ecstatic and semi-surprised to hear this, but the way forward was innovation. And innovation was brought up 22 times in the 20th Party Congress. So I think the government is really, I don't know if it's a result of what happened last summer, but I think the government is really interested in supporting innovation entrepreneurship. And in fact, after the 20th Party Congress, we got a lot of invitations to attend meetings about promoting innovation and entrepreneurship. So I think if that part of the policy and economy is there, it's great.
So I'm going to take all that as a kind of positive, constructive, still doing a lot of business in China and still excited about China. We've got three other panelists who, although they invest globally, also invest in China. So let's see if they agree with you or not, Ian.
So I think what we really agree on is the China to world strategy, the young Chinese entrepreneurs who want to build global businesses. I think the complications as a foreign investor in China and some of the domestic economy is greater. And I think there's a lot of positivity after the last few weeks, but I think people want to wait and see how that transpires over the next few months and years before rushing back into some of those sectors and in some of the later stages. But I think when you look at the largest three Chinese companies for the last 10 years, ByteDance, Binance, and Shein, are all essentially serving the global market. And two of them don't have a single Chinese user. One of them has half Chinese and half non-Chinese users. And so we do see that sort of young Chinese entrepreneurs building global businesses, initially from China, but over time they increasingly migrate headquarters to Singapore, the US, or elsewhere. And I think that we're very bullish on.
So the China to the rest of the world strategy rather than the domestic China strategy is how you...
Yep. Well, and look, I think the domestic China strategy, it works in some of the areas, the kind of policy-sensitive areas, electric vehicles, batteries, semiconductors, some of the areas of biotech. But I think that some of those areas are quite capital-intensive and potentially have lower rates of return over time than the kind of internet economy of the last 10 years. I mean, the cost of building a gigafactory is very different than the cost of building a algorithm-based social product. And so I think There are unquestionably some great companies to be built there over the next few years in China, but whether those will be the same rates of return for foreign investors, I'm skeptical.
Jenny, how do you weigh China against the rest of Asia that you also invest in?
Yeah, so we have been active in China. I think, as I mentioned, while the pace has come down as well, the bar has gone up. The areas where we've been particularly still very focused in terms of investment, I think one is the whole EV area. Along climate tech, it's not just about, so we're seeing that electrification of vehicles is happening at the edge, right? And what that is doing is that it's forcing a reconstruction of the energy grid from a very centralized power grid historically to now a very distributed grid. If you're going to support electric car charging at the home, in commercial buildings, in public facility as well, the entire stack has to change. And I think because of that, we are seeing new innovation, new startups that are now trying to address this issue of that energy transition change. In the sense, these are companies, and coupled with the fact that China has very deep manufacturing expertise in areas to do with energy storage, right? When you think about solar panels, you think about wind blades, 80-90% of the hardware is actually manufactured in China. If you extract and look at it, are they data sensitive? They are not, right? If I buy a solar panel on my home, it's my data, I own it, I just bought the hardware. So in that sense, in this vertical, this is where we see that China still has opportunities to create companies that can be global outcome, and at the same time be able to contribute, to what we call, whether it's climate tech or energy transition. So this is one area that we are seeing actually pretty big upcoming company. And then if you look at it, EVs, right? So cars, you have the European cars, you have American cars, Japanese cars. In a way, there's never one car that everybody around the world wants to own, right? There's multiple models, and so as a result, it's pretty fragmented. And so you can believe that it is possible to actually have China also come out with the new energy cars, and they could be part of the global ecosystem. I think the other area, as I mentioned and alluded to, is automation. I think that the fact that automation is a combination of not just the AI, the compute, the visioning, but also the robotics arm, and then associated with that, the entire back-end manufacturing. So it's actually a system integration stack. And so when you apply the system integration stack of automation, whether to warehouse, logistics, lab, or even drug discovery, then we're now seeing that, again, this is one where, from a data-sensitive perspective, the data is owned by the owner of, if you're lab using the system, you actually own this data. So in that sense, there are definitely areas that are not data sensitive. And so it's also one area where we have seen, I wouldn't name the names, but we have seen Chinese companies having revenue over 60-70% global, with customers from Japan, US, Europe actually buying into the product. Now, the key question, though, is that with the current environment that we're in, definitely we're seeing that entrepreneurs, they go where the capital, they go where the market opportunities is. And so a lot of the frequent discussion we have with our entrepreneurs in different stages is, how do I now have an alternative headquarter? Right, so they're not labeled as a China-only company trying to sell to the world, but can they have multiple headquarters where they're also willing to locate some of the manufacturing or the assembly into regional areas to allow them to support global growth. So I would say business as is probably not possible, but how do you now work with these companies, the great companies, to figure out how they can continue to sell globally, but in a more distributed manner as well.
Bill, you've obviously done a lot in China. You're on the board of ByteDance, I believe, which is one of the great China success stories. But again, as I said at the beginning, you invest all around the world. So how do you weight China at the moment in terms of interesting opportunity or less interesting opportunity?
Well, I'd like to tie together what Anna, Ian, and Jenny said in that I think China for China is still a very good opportunity. It's a large growing market, consumer healthcare, higher spending, very attractive. China for the world, I think very interesting. We think of ByteDance actually as a global internet company with Chinese heritage. And I think when you take Shein, ByteDance, Binance, many others, they really are serving the world. So I think China for the world is still there. And I think what Anna said, the innovation economy and the quality of the entrepreneurs is still extremely high. And in certain areas like EV, climate tech, AI, they're global leaders. I mean, they're either at par or ahead of the world. So you have to, as a global investor and a growth tech investor, you have to be focused on China. Now, what's changed is the risk profile has changed in a significant way. And it's changed because of U.S.-China relations. You know, we might get outbound investment screening that says we can't invest in certain parts of China that have, you know, certain national security implications. We don't know how wide that's going to be. That's one significant change. The exit environment, for so long we had basically the VIE structure, Cayman companies listed in Hong Kong, NASDAQ, New York quite easily. That's being called into question now in terms of where can we exit, and we talked a bit about exits before. That formula is probably over, and just, you know, elevated geopolitical issues related to China. And so very attractive, but the risk profile and the risk package is higher, and we've got to factor that all into our investment decision making.
But what you didn't mention as a risk factor is Chinese policies, that you could wake up one day and find that they've made some policy shift here or there, and whether they really
should
are.
Have, Steve. I should have, because if you know, my experience at ByteDance has been, you know, we're debating between Chinese policy issues and U.S. policy issues. It's both sides, and you may try to solve one, but you've got the other. I mean, for example, you know, export of Chinese IP that might be used for markets outside of China. The Chinese government is very sensitive to that. What's happening to that IP? Where's it going? And the same, you know, the U.S. government is sensitive to what capital expertise is going into China to help them build their domestic technology industry. So it's both sides, and I think what that's meant for all of us is that, you know, the level of risk is higher, the investment decision making is tougher, and there's certain areas that we're probably going to have to avoid because the risks are too complicated or unknowable or unsolvable. But I'd still say, with the second biggest economy in the world still growing, I think when they come out of COVID, they'll return to growth. It's too big to ignore. There's too much opportunity.
But what I'm hearing from all of you, and we're out of time, so this will be, I guess, the last comment. What I hear from all of you is more caution about China, both for a better assessment of all the risks, the valuations, all that kind of stuff, and not doing certain sectors, not doing certain kinds of investments, but still interested in China, but a little more careful about it.
Absolutely.
Yep. All right. Well, thank you, panelists. This was fun. Thank you, audience. And
thank you.
Great.
on to the next.
Thanks, Steve.
Thanks.